Quick disclaimer, this is an AI voice, which is not going to be perfect. There is a transcript in the description as well as subtitles for you to read along with. An efficient allocation of resources requires a way of measuring the costs of using those resources and the revenues generated by their use. Revenue is the total income a business earns from selling its goods or services. Costs are the expenses that a business pays when producing and delivering its goods or services. The revenue that a business receives can be calculated by multiplying the number of units sold by the price per unit, and the number of sales that a business has made can be calculated by dividing total revenue by the price per unit. There are 4 types of costs that a business needs to be aware of, which are average costs, fixed costs, variable costs, and total costs. Average costs are the total cost divided by the number of units produced, representing the cost per unit. Fixed costs are costs that stay the same regardless of the amount produced or sold. Variable costs change with the amount produced and are calculated by taking the fixed costs away from the total costs. Total costs are the sum of fixed and variable costs. The business may experience changes in the costs of production or the revenue that it receives. Percentage change is calculated by dividing the difference between the new value and the original value by the original value, then multiplying by 100. Contribution per unit is the amount each unit sold contributes to covering fixed costs and generating profit, calculated as the selling price per unit minus the variable cost per unit. The break-even point is where total sales revenue equals the total costs, meaning there is no profit or loss. The contribution per unit can be used to calculate the break-even point by dividing total fixed costs by the contribution per unit. The margin of safety is the difference between the break-even point and the sales that a business actually makes. The margin of safety is calculated by subtracting the break-even sales from actual sales. Break-even analysis helps assess the strengths of a business by determining the levels of output needed to remain in business and shows the impact of changes in price or costs. It also helps decide whether a business idea is worthwhile and supports applications for financing by demonstrating financial feasibility. However, break-even analysis is limited as it relies on forecasts and assumes that all output will be sold and that variable costs remain constant regardless of the quantity purchased. Additionally, it becomes more complex in businesses that sell multiple products, as varying product lines can complicate cost and revenue calculations. Profit is the financial gain a business makes after paying all of its expenses. A loss occurs when a business's total expenses are more than its total revenue. In a competitive market, profit can act as an incentive for new businesses to enter the market by offering the potential for financial gain, while consistent losses incentivizes existing businesses to exit the market. There are 3 types of profit, which are gross profit, operating profit, and net profit. Gross profit is calculated by subtracting the cost of goods sold from total revenue. Operating profit is calculated by subtracting other expenses from gross profit. Net profit before tax is calculated by first subtracting the interest that the business has paid from the interest that the business has received, then subtracting this from the operating profit. Net profit is calculated by subtracting the tax that the business has paid from the net profit before tax. Profit margins are used by businesses to find what percentage of their sales is actually profit and are not used to pay for an expense. Gross profit margin is calculated by dividing gross profit by the total revenue and multiplying by 100, which shows the percentage of sales revenue that the business keeps after paying its costs of production. Operating profit margin is calculated by dividing operating profit by the total revenue and multiplying by 100, which shows the percentage of sales revenue that the business keeps after paying all of its expenses, such as wages, rent, insurance, and utilities. Net profit margin before tax is calculated by dividing net profit before tax by the total revenue and multiplying by 100, which shows the percentage of sales revenue that the business keeps after paying its expenses and how the interest they receive and pay affects the business profitability. Net profit margin is calculated by dividing net profit by the total revenue and multiplying by 100, which shows the percentage of sales revenue that the business keeps after paying its taxes. A statement of comprehensive income, also known as the profit and loss account, provides a summary of a business's financial performance over a specific period of time. It starts with revenue and subtracts the cost of goods sold to show the gross profit. Next, it subtracts the expenses from gross profit to calculate the operating profit. Interest income or expenses are then factored in to calculate the net profit before tax. The tax expenses are then subtracted, calculating the net profit. This comprehensive statement helps businesses evaluate their overall profitability, monitor their performance, make informed financial decisions, and communicate financial health to investors and stakeholders. Firms can increase profit by raising prices to boost revenue, lowering costs to improve profit margins, and increasing marketing efforts to drive higher sales. However, lowering prices can attract more customers and potentially increase overall revenue, depending on market conditions and cost structure. Profit is the financial gain a business earns when its revenue is more than its expenses. Cash flow is the movement of money in and out of a business, including all cash receipts and payments during a specific period. The difference between profit and cash flow is that profit measures long-term financial success by accounting for all revenues and expenses, whereas cash flow focuses on the availability of finance to the business, ensuring it can meet short-term payments. Cash flow is important for business survival as it ensures the company has enough access to finance to meet its short-term costs, such as paying suppliers, employees, and covering operational expenses. A cash flow forecast is a financial tool that estimates the expected inflows and outflows of cash over a specific period of time. The cash flow forecast starts with the opening balance, which is the cash that the business starts with. The cash flow forecast then includes the cash inflows from sales, loans, or other revenue sources. The cash flow forecast then lists the cash outflows, such as rent, wages, and marketing. The cash flow forecast then has the net cash flow, which is calculated by subtracting the cash outflows from the cash inflows. The cash flow forecast then shows the closing balance, which is the net cash flow added to the opening balance. A cash flow forecast helps businesses identify periods where they do not have enough cash, allowing them to find out when they may need to secure credit to cover gaps in their available finance. By anticipating these needs, businesses can minimize the risk of running out of cash, ensuring they can meet financial costs and avoid disruptions in their operations. Thank you for watching this video on revenue, costs, profit, and cash. I'll see you in the next lesson.